Nothing exists as the only way to trade. There is no one singular trading edge. There is, however, one trading habit that all traders that wish for success must follow, and that is to consistently apply your trading edge every time you face your charts. Now, for many traders that I know, including myself, part of that edge is having a confluence of factors lining up for each and every trade. Inside of each variable of that confluence is consistent application of that variable. Now, to better understand what that means for your trading habits, consider that you use zones of potential support and resistance in your trading. You would have a fundamental way that you locate these zones, and it does not vary each time that you use them. Let's take that further. Imagine that you don't use the standard method of locating extreme turning points as your first approach. You take more interest inside of the extremes. Now, the green check marks on this chart indicate where you deem the true areas of support and resistance reside in this immediate location on the chart. While many traders stick with the conventional extremes, you go inside to the left of the extremes and project to the right. The white arrows indicate where you look for a lower low or a lower high, and then look to the immediate left for the low high that came prior. Now that begins your zone of interest. The stars indicate where price meets the zone, and this is where you take interest in seeing if there's a potential to trade on the chart. You don't consider ever changing your approach this one time to fit whatever the chart is printing, and you repeat it over and over again. That's being consistent. Now, as a side note, inside of the extremes is where I personally find use for horizontal and diagonal lines to indicate support and resistance, even on a longer term basis. And I first heard about this method through Jack Schwager, who wrote about it in 1999. Now, for reference, after price broke the highest line and rallied, it returned to the exact same price point 2 months later. Now, time, it refined your trading. Inside of this blog and the posts and the videos I've made, I've covered many ways that I look at what the chart is presenting. Now, things refine as your experience grows, of course, but regular readers and watchers will notice that the basics have remained the same. There's no jumping around in extreme changes with the trading approach, nor in the usage of technical factors or indicators. Consistency is vital, but always has an escape hatch for refinement to allow for a simpler process without having a negative influence on the edge. Now, I covered trading in the Euro futures contract a short while ago, and to show consistency, especially in the form of Confluence, I'm once again going to cover this contract. Now, I got hit with what appears to have been the flu, and I was sidelined for quite a while from trading. On the night of February 3rd, I sat down to look at the daily chart of the Forex market. That's my favorite market to swing trade and position trade, and with the US dollar CAD positions on and headlines of a weakening greenback and stronger oil prices, which was short-lived, I wanted to see the structure of the chart. I then brought up the Euro US dollar chart and I saw the following. Now, the previous Euro post was after price had broken the double bottom and was bought back up into the range, which offered long trading opportunity. The Euro stayed inside of a channel, condensing, and I've written before that condensing ranges will most likely have sharp breakouts when they come. Now, the general rule is you don't fade the initial drives. Price drove to the upside, and given the opportunity that may be present due to this drive, I chose to be in place for February 4th and after the unemployment claims number came out. Now, prior to the 8:30 number release, price had already put in about a 150 pip drive. The release carried it further, and we topped out around 20 pips higher. Now, from a technical point of view, we have a confluence of variables that have lined up that pointed to a potential shorting opportunity. Number one was an internal demand line that was in place from September 2015 and then broken and extended out here to present day. Number two is a 100% projection of the prior drive in price as shown in the yellow. And number three is a 161% extension of the prior swing in price as shown in red. Now, these are standard tools that I've shown in the past, and they're shown here in a consistent manner from prior trading tips. Now, as the news release played out, we found ourselves banging on the potential of at least some slight retracement in price. Well, the setups and targets occurred on the 5-minute chart. For better detail, I'm going to use the 2-minute chart. Another side note about finding levels inside the extremes, the line marked with the blue star not only added confluence for 2 shorts, but it also capped price 4 hours after the last test shown here. Now, the upside drive in price has strong volume numbers, and as expected, All those longs were eaten up when price immediately turns and wipes out all their gains. Now, once you see a sharp move like this in price, trading the next pullback in this context can be a pretty high probability trade. Now, longs, they're about to regret jumping on that extended move. Price rallies to the area marked by the green arrow, which anchors at number 1 as resistance, broken to the upside, back to the downside, and then again shows resistance at the same price zone at number 2. It also has retraced 50% of the prior collapse. A short trade is initiated on the 5-minute chart. The price target is a 100% projection of the first swing down in price, a measured move. That also coincided with a zone that contains a 1200 level, an internal demand line, a 200% extension of the swing up into the shorting zone, and an area that resisted price in the recent past. You can see price slam into the profit area, quickly retrace. Refer back to the 5-minute chart to see what I was actually seeing at the time. I didn't see this 2-minute chart. Price continued slightly lower than the demand line and then started to retrace off the top of a prior range. It's very easy to get caught up in a smaller time frame, but keep in mind that the 5-minute was a trading chart, and the lower time frame was simply used for finer detail of the zones that were seen on the 5-minute chart. Now, I'm still expecting a bigger picture pullback and was mapping out a confluence zone during the pullback. So consistency played out again. Showing the 2-minute chart again, price has pulled up into our zone of opportunity. Number 1, this is the same resistance line that we used in the first trade. Number 2, this is the first swing up in this swing projected upward, showing us an A to B equals a C to D. Number 3, this is a 100% measure of the final thrust into the high that came just prior to the start of our down move after the news. And number 4, this is a 261.8 extension of the retrace that came after the first leg of the move. Now, price action behavior is what triggers this trade, as the 2 thrusting green candles are unable to continue the move, and once the rollover of about 50% of the final green candle occurred, a market order short was undertaken. Now, it's not always clear sailing. We run into issue at the first red X. The retracement of 78.6 of the low to high of the swing is a line in the sand area. If price does not break this level, we often see a retracement in price that can erase your gains. If those break, though, we can be more confident in our profit target below, the low being hit. Now, to add to this, I also have a balloon line marking off an area of potential support that may not be obvious. Keep in mind the internal levels that are used. Refer back to the 5-minute chart, and why this level is here should be obvious. Hint, look for a long lower shadow that comes prior to the extreme low. Now, what keeps me confident in the trade is the backward bounce off the broken demand line at the second red X that we've had in play all session. The profit targets are consistent. There are many ways to take profits, including trailing and your fixed targets. Which ones you employ may depend on the context you find yourself in, but like anything in trading, consistency is key. The profit targets for the second short are found in the same consistent manner as the previous ones. Now, the total combined for both trades is 61 points. Number 1, this is the 127% extension of the swing into the shorting zone. What you can't see on this chart, but you can see on the 5-minute chart, is a blue line on the left of the chart. It's drawn in the same manner as described earlier, giving us a resistance zone turned into a support zone and then confluence at this level. Number 2 is another A to B equals C to D, a 100% measurement from the previous larger leg of this down move. Number 3, this is a 100% symmetry project from the high of the previous day to the low prior to this high. It's a measurement of a previous pullback, which can be considered a normal pullback in the current market environment. I find symmetry very important in my own trading, so for clarity on number 3, I deleted everything from the chart and I left this measurement marked with an X, as well as the internal support and resistance lines, so you can see how relevant they are. The yellow highlights the internal levels, and you can see that they acted as both support and resistance. Now, I want to wrap this up with one more example of consistency and using measured moves for profit targets. Now, these are not one-offs, and they appear over and over again. They've been covered in many of my writings, my trade examples, and measured moves play a large part in this trading example. Now, staying with our 15-minute chart for the bigger view, let's see how the spike out of the range and the eventual collapse terminate at measured moves that occur often enough to form part of a developed trading edge. The yellow highlights our trading range found within our internal support and resistance lines that have had multiple hits. The price spike on the upside is 200% of the width of the range. It's a common measurement. The blue highlights a demand line break measurement. We take the high inside of the demand line, which is the spike high, and we anchor it to the breakout point. You can see that price again terminates in the zone of 200%. Now this may seem like a lot to digest, and it really is. It's one thing to understand what you're seeing and another thing to be able to implement it in a consistent manner. It takes a lot of commitment to get a handle on trading in this fashion. And that's one reason that many traders seek a more mechanical approach to the trading. Now, NetPicks has been producing effective trading systems since 1996, and as a thank you for reading, please download the free version of Trend Jumper, which is one of our most effective trading systems to date.